Welcome to our Reconstituted Forecast Direct series. And in this series, we're going to bring you once a month a conversation with a member of the forecast team, a member of the Anderson faculty, and some guest speakers, all talking about important issues of the day and bringing their research to bear on this. You'll be receiving notifications in your email. And to start this off, we're going to have a conversation with Leo Feler. Leo is a new addition to the forecast team. He was previously at two consulting firms, was on the faculty of Johns Hopkins, has his Ph.D. from Brown University, and is going to be leading our US forecast. But Leo has written an article, you can find that on our website, about the current issues of employees or drivers, depending on your point of view, of Uber and Lyft, and the ruling by the courts on AB 5 that the drivers are employees, and the initiative that we'll be voting on here in California shortly about whether the drivers should be exempt from that ruling and treated as independent contractors. So let's start off with Uber and Lyft. Now, we all know what they are. We know that they have changed personal rides for hire in the entire industry. But Leo, why don't you start us out by giving some perspective on how big is this? How important is it in the economy, not just of California, but more generally?
Jerry, thanks very much for that introduction. I'm thrilled to be joining the forecast team and very honored to be part of UCLA Anderson. So Uber and Lyft, they have revolutionized the ground transportation industry. Just in California, just in 2018, our estimate is that they added 171,000 jobs that wouldn't have otherwise existed in ground transportation. And our estimate is that they added $3.3 billion to the California economy for earnings for these drivers that wouldn't have otherwise existed. So these are big numbers. It comes out to about $22,000 per additional Uber and Lyft driver. This is not to mention the benefit that they provide to consumers for having this option of being able to take an Uber Lyft versus having to take their own cars versus having to find alternative forms of transportation. We see that it really increased, it expanded this market for transportation services.
So, one of the questions that we as economists always ask is, all of these jobs were created. Had they not been created, what would these folks have been doing?
So the interesting part for Uber and Lyft is that most of the drivers actually have other sources of income, actually have other sources of jobs. So it's not clear to me whether or not they would have simply not had these opportunities for supplemental income. I'm not sure to the extent that there's so low barriers to entry that there would have been alternatives, that these jobs would have been created in some other place.
So this may be substitutes for leisure time, but leisure time that perhaps was not very valuable to them, and they would prefer to drive for a few hours or a few days a week to earn additional money.
Exactly, and that's, there was a recent survey of drivers in California, and there's some data from two economists, Hall and Kruger, that looks at the kind of people that actually participate in driving for Uber and Lyft. And so more than half of these worked less than 16 hours a week. 84% had other full or part-time jobs. So and 74% said that they did this for supplemental income. And so these numbers really suggest that the majority of Uber and Lyft drivers are doing this on the side in addition to something else. And this is really taking into leisure time that they would have otherwise been spending, or perhaps some other job, some other part-time job that they might have had, but this is substituted for that.
Yeah, so the aggregate is not the full story. There's some economic loss. Taxi drivers who are now Uber drivers are kind of doing the same thing, but there is significant increase in economic activity, substituting leisure time for work as an Uber or Lyft driver.
Exactly. And actually, the numbers that I gave you in the beginning of the additional 171,000 jobs and the additional 3.3 billion in earnings that were generated, that is on top of what we forecast would have been the case had these services not come about. So had taxi driving continued the way it had been continuing in the past, this is supplemental to that.
Okay, so that's net jobs.
Yep.
So the court ruled that Uber and Lyft drivers fit the requirements that the state has set out for defining who is an employee and who is an independent contractor. Uber and Lyft are sponsoring an initiative to get an exemption. What are kind of the key issues here?
Right, so this is Proposition 22. And Proposition 22, which California voters will decide on November 3rd, basically exempts Uber, Lyft, and other platform drivers. So this also includes delivery services like DoorDash, Uber Eats, exempts these drivers from being classified as employees. And the key question is who has the responsibility of paying for the taxes and benefits associated with these drivers? Is it the companies, Uber and Lyft and DoorDash and these platforms, or is it the drivers themselves as contractors, as workers who are essentially their own small business owners, self-employed in a sense, of doing Uber, Lyft, doing DoorDash as if it's their own small business?
So in the past, a self-employed person, such as a plumber, who entered a recession and found themselves with slack business, maybe no business, had to rely on their savings. And that was really typical also in the construction industry. There were higher wages in the construction industry because there would be spells of unemployment during recessions. And so that's what independent contractors have done in the past. However, in this recession, what we saw was that Uber and Lyft drivers and the like received unemployment compensation,
right?
Even though they didn't pay into the unemployment compensation, didn't pay unemployment compensation taxes. So, there are kind of two issues there that I'm curious about. One is this is a social insurance, and the same thing is true with other social security, for example, or workman's compensation. And the idea is to spread that risk for all insurance, is to spread the risk on the widest base. And the state is saying these folks should be part of that base. In the last recession, that price tag, that insurance was picked up by taxpayers, right? So it was a spread over all US taxpayers. So what are do you have thoughts about the equity issues here of the exemption, or is there something other than just one side or the other?
So this recession is also very unique, where we specifically wanted to incentivize people not to work. We wanted to incentivize people to stay home and shelter in place, if you will, and try to contain the virus. This is different from other recessions where we wanted people to be, out and working and looking for new jobs. And so the expansion of unemployment to include independent contractors is something that's very novel. It's not clear to me what it means to be unemployed from Uber and Lyft, because there's never a point where Uber and Lyft lay off workers or tell people not to drive. There was simply not enough demand for it. And, at the point the demand resumes, people can come back on, but there wasn't even the opportunity to do that given that we were sheltering in place and there were no rides. Now, the one thing that's interesting in this case is that where we have seen a big surge is in services like Instacart, Shopify, DoorDash, Uber Eats, all these delivery services that have seen a huge spike in demand, where the benefit that you can be an independent contractor means that you can shift from using an Uber or Lyft platform to using one of these delivery platforms and working for that instead. And so there is an opportunity to actually work in these other industries and not be unemployed, to have these other forms of earnings. The state does benefit in terms of tax collection from the extra earnings generated from Uber and Lyft. But it comes in the form of income tax payments that these workers are paying on the supplemental income that they're earning that they might not have earned if not for the fact that Uber and Lyft existed. But you're right in the sense that there's no explicit unemployment insurance tax that they're paying.
Is there a moral hazard problem? I mean, I'm thinking of long-term capital's failure creating a moral hazard problem with risk-taking on Wall Street. No one likes to have their income reduced with taxes. If you think that you're still covered with unemployment benefits and you don't have to pay unemployment taxes, wouldn't you favor the initiative? But is that kind of the efficient thing to do from an economic analysis point of view?
So I think the important thing here is to consider how often are we going to have a situation like we had this past year, where we explicitly wanted to incentivize people to stay home and we wanted to pay them extra to do that. And this is a, perhaps once in 100-year occurrence where we have this kind of pandemic where we want people to stay home and not participate in the economy for a period of time.
Yeah.
And the question—
So I'm going to agree with you. If the drivers understand that they are not covered in the future, I'm not sure that they understand that. But let's move on to some other issues.
Okay.
One that is kind of interesting to me is, let's suppose that the initiative fails. So now platforms have to pay into the state unemployment compensation and workman's compensation, their share. So they're going to have to raise prices to cover that, or at least somehow cover it, right?
Right.
They could cover it through reduced profits. They could cover it in some way through requiring drivers to be more efficient and sort of pushing it down onto the drivers. So, it's what we economists call incidence of the tax and where that is. But it'd be interesting to know the magnitude of it. Is this a 1% increase in fares or 10%? Do we have any sense as to how much this would be, let's say, for a 15-minute ride, which I guess is about what most rides are?
So Uber came out with an estimate for this, and they're saying that prices would increase anywhere from 25% to doubling to 100%. And the increase would be more in places where it's more rural, there's fewer rides happening, and essentially drivers are more idle and their driving is more occasional. But their estimate was, anywhere from a 25% to a doubling of prices to actually shift employees to being, or drivers to being employees. This isn't just paying into the state's tax system, right? This is also going to be the overhead and admin and management costs and supervision costs of actually having a team of employees that you now have to dictate where, when, and how they drive, and you have to manage the supply of drivers at any given point in time. So that's their estimate, right? 25 to 100% increase in prices, and their estimate is that this would reduce demand in trips by 20 to 60%. So we could see a really large decline in the number of consumers taking these trips. So that's one piece of data, and it's from Uber. We have another piece of data that every 10% price increase leads to about an 8 to 25% decline in ridership. The amount of the increase, it really depends on the benefits that these employees are getting, right? So the more generous the benefits, the more the prices would need to increase, all things equal.
So you brought up a whole bunch of things that I'd like to talk about. Let's start with, so the administrative costs.
Right.
And in your article, which I urge everyone to read, you talk about putting these administrative costs as well as the costs of insurance onto the drivers. So the drivers would pay something like a gross receipts tax, and that would be the contribution to the insurance funds, so that they would be covered and get their benefits, but it wouldn't go through the platform. If the estimates, let's take the estimates from Uber at face value. I'm not sure we want to, but let's do it. That would mean a 25% pay cut for drivers, right? Because they have the hassle of filing, and they don't have any economies of scale of filing. Everybody has to do it all themselves. This is probably even more costly. And they have to pay the taxes. So wouldn't you find that, going back to where we started, that these are people who are trading leisure time for driving for the extra income? Certainly at the margin, you're going to have drivers who say, it's just not worth it. It's too much of a hassle. And maybe a significant number of drivers, maybe more in rural communities where they don't have as many rides. So don't you get the same effect, whether it's on the drivers or on Uber?
So not exactly. The drivers already pay taxes because they get these 1099s that they then file when they're filing their own taxes. And so it would be, in addition to the 1099s that they're getting, are there any supplemental taxes that they now have to file, right? But
so they'll have lower income, but the administrative costs won't be as dire as I just described.
So they essentially already have the administrative costs in the sense that as 1099 contractors, they receive this income. Hopefully most of them are keeping receipts for gas, are keeping receipts for their car depreciation, for car maintenance, and deducting these as business expenses. So they already do this anyway, or hopefully should be doing this anyway. And this is any incremental tax filings that they would have. Now, the suggestion that I have is that this shouldn't necessarily be passed on to drivers, but there could be a surcharge, which is just the equivalent of raising the fares on passengers. And so we've actually seen other cities and other states implement taxes on ride shares. And so the city of Chicago, for example, has several different taxes that get baked into the price that the consumer pays that will pay for different kinds of services. So one, for example, is a congestion surcharge. There's a different price, a different tax that the city of Chicago will impose during peak times to discourage people from taking Uber and Lyft as opposed to taking public transit. And so in that same way, the state of California, different cities, different counties, could, if they wanted to, impose a tax on these ride shares that would pay for benefits to the drivers. And what those benefits will be, it's up to policy to come up with.
So there's one other topic I want to get into before we run out of time, but I think your suggestion is that if the proposition passes, the state has an option to have a independent contractor / platform worker be taxed separately so as to cover the social insurance.
Well, to implement it similar to a sales tax, right? The same way there's a sales tax on service, have a tax on Uber and Lyft rides.
So I mean, it's a gross receipts tax,
right?
As opposed to an income tax.
Yes, and it can be paid by the user of the service, not necessarily the
right.
The driver.
So the other topic that I'd like to get into, and I urge our listeners to read the paper. Uber and Lyft lose money. The only reason they can lose money is because they have venture capital that's supporting them, and they're burning through the venture capital. That's not a sustainable business model. They're going to have to raise prices. How much are they going to have to raise prices relative to what they would have to raise if they start paying these payroll taxes for their drivers?
Yeah, so I'm glad you brought that up. I think Uber and Lyft, the fact that they don't make money is correct, but they don't make money as a whole. On the rideshare portion, Uber actually makes a profit. And if you then include Uber Eats, Uber Freight, some of the new technology initiatives that Uber is implementing, the entirety of Uber is unprofitable, but the rideshare portion itself just became profitable. They actually earned about $750 million in the last 3 months of 2019 before the pandemic. And so actually, let me correct that. They were profitable until the pandemic, right? So
Okay.
assuming in normal times, the Uber rideshare portion is profitable, and Lyft was slated to become profitable late this year, early 2021. Again, if not for the pandemic. So the rideshare piece itself has matured and is at a point where it's right at the break-even point. But that means that if we then increase the costs, if we then impose all the associated costs of having employees, not just paying the taxes, but managing and supervising employees, then their costs go up. And in order for them to break even or be profitable, they have to pass those on to consumers, or they have to decrease compensation for drivers for it to be.
Yeah. Or the incidence could be on the investors.
Right. But investors are only so patient for so long. So far they've been willing to incur losses.
Correct. But as with the minimum wage, we just did a minimum wage study over the last 4 years. In fact, we'll talk about that on a future Forecast Direct. But the incidence can be split, right? With some on the drivers, some on the investors, some on the customers, especially late night customers coming back from drinking establishments if they ever reopen.
Right.
Yeah. So Leo, thanks for joining in this first Forecast Direct and really taking charge of the Forecast Direct and moving us forward. And I look forward to going back and rereading the paper after our discussion.
Thanks very much, Jerry. Thanks for the excellent questions. And I hope this was useful and informative.